Hey, my name is Mike Clare. I head up distribution for Jalotech. I'll be introducing Jonty Sachs, and I'll be introducing Andoni Nicolai, and I'll be facilitating the Q&A at the end. Please just type your questions on the chat box, and we'll attend to all of those questions. All right, so right at the end, we'll be quite interactive. What we're seeing in the marketplace is that interest in cryptocurrency continues to escalate. Things are very, very volatile at the moment. And if you keep your eye on Bitcoin and Ethereum like I do, you'll notice that they've been trending down, and many people are seeing that as a buying opportunity. Opinions are diverse. Volatility continues to be extreme. But there's no doubt, and I don't know if you agree with me, but I'm seeing the media sentiment and the commentary that we're seeing shifting away from negativity and the language of fads and scams to lots of positive press about cryptocurrency, and acceptance seems to be growing. And certainly the financial advisor community that we're chatting to, there's high interest. They're very, very curious, and their clients are asking them a lot of questions. So this is an asset class that definitely cannot be ignored. My view is that we should all join the global conversation, that we should continue to educate ourselves, and then we should acknowledge that regulation is closing on an innovation, which is always a good thing. I also believe that you should partner with Jalotech. You are educating the market and partnering with IFAs, and we are seeing many IFAs linking into our workshops and webinars, and we hope to be engaging with you again in the new year. One thing you can't ignore about cryptocurrency, and Andoni gives us quite a bit of airtime by way of a slide, is that the asymmetric returns that are achievable from cryptocurrency simply cannot be ignored. I'm going to hand over to Jonty. Jonty's a partner at Jalotech. He's head of new business and marketing, and I'm going to ask Jonty to share insights from his side and just talk on behalf of Jalotech and talk about what Jalotech's intentions in the cryptocurrency space are. Over to you, Jonty.
Mike, thank you very much, and everyone, thanks for attending. I must say we were quite overwhelmed at the positive feedback from the market. I think, just to echo what Mike was saying, initially there's a lot of skepticism around cryptocurrencies, but what we've realized is that there's a key role we need to play in education. Many people think of crypto as a cryptocurrency that's trying to replace the rand or the dollar, effectively fiat currencies, but that's just a small portion of the market. There are lots of investment opportunities, and we thought we'd play a key role in educating the space. What we are seeing is advisors, high net worth, and just typical investors looking for exposure for higher returns, but understanding the risk and volatility that cryptocurrencies do play in this market. As a business, we're looking to offer a convenient, easy way to enter the space without having to go through a long process and then of opening an account with an exchange, and then understanding which cryptocurrencies to purchase. We've created a quite innovative basket of cryptocurrencies, and I'll touch on that very, very briefly a bit later. But the purpose of today is really education. What we do is encourage questions. So if you do have any questions, feel free to insert them in the Q&A section, and we'll deal with them at the end of the presentation.
Okay, so today is all about understanding blockchain, debunking some of the myths around cryptocurrency, highlighting the many investment opportunities that are emerging, and also understanding the tax and regulatory environment that we all operate in, followed by the Q&A. Andoni Nicolai is going to be following Jonty, who's going to kick off the presentation. Andoni is head of digital assets at Jalotech, a BSc Actuarial Science, and has brought a lot of crypto IQ into the Jalotech team. But kicking off today's session, supported by Andoni, is Jonty. Thanks, Mike.
Okay, so what we'll be doing is we're going to be having a series of webinars. The first webinar is really to give everyone the real fundamentals of this exciting asset class. Again, if you have any questions, feel free to insert them in the Q&A section or the chat section, and we'll deal with them at the end. So just to repeat what Mark was saying earlier, I'm going to deal with, or Andoni and I will deal with what is blockchain, where we're seeing investment opportunities in the market, typical profile of an investor, and the updates in the regulation and the tax treatment of cryptocurrencies. So to start off, what is blockchain? Now, blockchain is a network where the participants or the people on the network independently verify a transaction. What do I mean by that? Well, let me give you an example. Let's assume Postnet ran on a blockchain network. And what this would mean is every single branch or franchise would be on the blockchain. Now, if a sender, so let's say, for instance, I come along, I walk into a Postnet in Pretoria, and I drop off a parcel. What will happen simultaneously is the blockchain network will record that John T. Sachs has dropped off a parcel in Pretoria, and that parcel is destined for Cape Town. But simultaneously, Bloemfontein, George, Cape Town, Johannesburg, and the rest of the branches will record on their ledger independently from each other that John T. has dropped the parcel off in Pretoria and is destined for Cape Town. Then what happens is a delivery man collects the parcel, Mr. X. As he collects the parcel, again, across every single branch or franchise of Postnet, every single ledger independently will verify that Mr. X has collected John T's parcel in Pretoria, destined for Cape Town. The driver then drives to Bloemfontein. When he arrives there, every single branch or office of Postnet will record he's now arrived in Bloemfontein. Now, this is a simple example, but what this blockchain has achieved is that first, it prevents potential of any ledger or records being erased or manipulated or fraud effectively to occur. Because what would happen is if the delivery person arrived in Bloemfontein and wanted to collude with the head of the branch in Bloemfontein and decided to erase the fact that my parcel has arrived in Bloemfontein, he would need to do that in George, in Cape Town, in Johannesburg, and across every other peer on the network. Now, on 5 networks, if there are 5 peers, potentially it's possible. But when we're talking thousands and millions of peers on a network, it's impossible. And that's a fundamental benefit of a blockchain network, is that it allows independence, and it prevents one authoritative figure controlling the network, making decisions which might not be in the best interest of the peers or the people on the network. So I gave you an example of Postnet. Now, my personal belief is that the technology around blockchain is really the future for many, many businesses and for people that use these businesses. And I'll give you a few examples that I think you can relate to. So currently the JSE, when you do a transaction on the JSE and you buy shares, a central body called Straight verifies the transaction. It says John T has purchased X amount of Anglo Gold shares. Now, this transaction could easily be done on the blockchain at a fraction of the cost that Straight pays, and at a speed, a rate which increases the efficiencies tenfold. If you look at what happened earlier in the year with the JSE had its largest trading day, and the next day it opened much later because it was still in the process of finalizing trades. Well, that wouldn't happen on a blockchain. Transactions can happen relatively very quickly and very efficiently and at a really small cost. Another example is CompuTicket. So let's assume there's a comedian and I log on to CompuTicket's website. I purchase a ticket. As soon as my ticket is purchased, all the role players will be informed. The actor will know there's a ticket sale. The venue will know how many tickets are being sold. The suppliers of the lighting will know and potentially receive payment. And me as a consumer, I will receive, and I'll discuss this a bit later, an NFT, a digital token representing my ticket. I could then potentially sell that to someone else on the market, or I could keep it as memorabilia. But these are just a few examples of many, many businesses which I believe in time will adopt blockchain technology. The question is, which network will they choose? And if you're an investor and if you've chosen one or multiple blockchain networks which you think will be adopted at a much higher rate, then the potential for returns is really, really significant. And we'll touch on a couple of these examples a bit later. But I think as a fundamental, what you need to understand is a blockchain is a network, effectively infrastructure, where the peers or the people on the network independently verify transactions. Now, the polar opposite is a centralized network. And there are a number of examples that we deal with today. The Reserve Bank is a good example, where the peers, being the banks, report to the Reserve Bank. The Reserve Bank is the central decision maker. It controls decisions. It issues decisions which may not be at the benefit of individuals. Another example is the Master's Office. Property sales, we all know how long it can take to transfer a property. In the future, there's a high probability that all property sales will be done on a blockchain, instantaneously, safely, securely, and at a very, very low cost. But at the same time, securing the purchaser and seller's details and ensuring that the true owner is verified and registered to that property. So where does blockchain fit into the cryptocurrency ecosystem? Well, if you look at the bottom of the screen, blockchain technology is really the infrastructure, and it's referred to in the cryptocurrency world as layer one. It's the bottom layer of cryptocurrencies. Then businesses, or the correct term is protocols, build on top of these blockchain infrastructure and then operate their businesses or protocols. And I'm going to break this down in a few minutes to come. So where we will be moving on to is where are the investment opportunities in the market? I think what many people, the mistake many people make is when they hear cryptocurrencies, they think Bitcoin. They think a cryptocurrency is an asset that is looking to replace the dollar, the rand, the pound, or globally termed as fiat currencies. Well, that is an opportunity in the market, but that's just one of many opportunities. And what we'll be doing is dissecting the various opportunities out, in addition to a cryptocurrency that's looking to replace fiat currencies. We'll be looking at other opportunities that are in the market. So to start off, I'm going to hand over to Andoni. He's going to take us through cryptocurrencies.
Excellent. Thanks, Johns. Okay, so that's a great foundation to start off with. Nice explanation from John T, showing how blockchain provides the infrastructure for the crypto market. And there's a wide array of different applications, but the first and most obvious application of a blockchain is to create private currency or non-sovereign currency. So if you, like me, are less than the age of 50 years old, we've only ever lived in the era of fiat currency. It's the only type of money we've ever known. But previously, we lived on a gold standard. People used metals as money. And even longer before that, people used all sorts of different objects as money: cattle, salt, shells, all sorts of varying and interesting examples. But now, with the advent of decentralized networks and cryptocurrencies, we now have these competing networks that are also acting as money. Just some examples here, three of the biggest examples currently. Bitcoin, obviously, everyone has heard of that, is aware, recognizes it, was valued at $1.5 trillion when the market was at its all-time high, but early in the year, recently has just dropped under $1 trillion market valuation. Binance is another coin, currently valued at $94 billion. And Tether is another interesting cryptocurrency use case where it doesn't have its own supply schedule. It's simply designed to be a stable coin. So for every Tether in existence, there's supposed to be an actual physical dollar backing it. And this is useful for people who are disconnected from banking networks and find it difficult to transact in the by traditional means. Now, all they need is an internet connection, and via that internet connection, they can essentially use the Tether rails to transact anywhere in the world using dollars. Next slide there, please, Johns. Thank you. Okay, so how do we evaluate which cryptocurrencies are good, which cryptocurrencies are useful, which ones we think will gain adoption, etc. And at the moment, there's a lot of varying opinions and many different valuation models. But for me, I think it's best to synthesize a mental model against which we can compare every single token that's competing to be a currency. And historically, this is how economists evaluated all different types of money that existed historically. So these are tried and tested, and it applies to any token or object that you can think of that could possibly be used as money. So let's go through some of these characteristics and see how cryptocurrencies match up against fiat currencies and commodities. So characteristic number one, scarcity. Again, this is quite obvious. I think humans inherently understand anything that is rare or scarce is valuable. And against this characteristic, cryptocurrencies far outperform fiat currencies. As we know, we've got central banks. Pretty much every central bank around the world is inflationary. They exist to print more money and bring more money into circulation. Especially since the great financial crisis in 2008, and now with the COVID health crisis, central banks have ramped up their printing even more to try and stimulate economies. And this is particularly bad for people who want to save in their national currency. So if I'm earning rands and I want to save my 10,000 rand at the end of every month and put it into a savings account, if my savings account can't outperform inflation, then I'm in real terms, I'm actually losing value and I'm not earning anything. Now, when we compare that to the supply schedules of cryptocurrencies, particularly Bitcoin, which has a fixed supply of 21 million coins, if you're a saver and you choose to save in Bitcoin as opposed to South African rands, you know that your value or your piece of that network cannot be arbitrarily diluted by some centralized body, because those rules cannot be changed as it exists on a decentralized network. So there's one obvious characteristic where cryptocurrencies outperform fiat currencies. Now, in terms of divisibility, another quite obvious characteristic, when you go to the grocer and you need to pay 1,000 rand for your groceries, you need to be able to pay with currency that you can get change in or pay for low-cost items. Now, if you think in terms of gold and why gold isn't widely used as a currency, it's simply because it's not easy to divide and transact in it. If you rock up at Woolies with a bar of gold, that's worth 25,000 rand, it's very difficult for you to shave off some gold shavings to come up with the right amount to buy your groceries. So they're quite an obvious characteristic as to why we don't actually use commodities as a medium of exchange. Transportability, another area where digital networks are far superior than the existing banking infrastructure or physical networks. So again, easy to use examples. Let's say you want to use gold to pay for an item that's coming from the United States. For you to ship that gold overseas across 2 borders and get it to the vendor that you're transacting with is very expensive, takes very long, and it's a very cumbersome process. Compare that to current banking networks. Some networks are very quick, but there's also very obvious limitations. Banks are closed on weekends. They're closed on public holidays. If you want to send an EFT or a wire transfer across borders, there are also additional delays and additional checks that you have to go through. Now, compare that to transacting with a cryptocurrency. It's pretty much at the speed of light, and anyone with an internet connection can send to anyone else on the globe, and it's practically instant. So there are very, very many positives and characteristics that cryptocurrency improves upon versus existing monies. Recognizability, again, that's pretty self-explanatory. Currencies need to be resistant against being able to being counterfeited. And as a vendor, you need to be able to receive a currency that you understand and that you recognize. Durability is another interesting characteristic and something that often gets overlooked. And I think a good way to think about this is look at the last 100 years of fiat currencies. And I think if you go down the list of all the fiat currencies that have existed in that time, a vast majority of them have either disappeared completely or gone through episodes of hyperinflation, where their value has essentially dropped to zero. And they have not, I think the average lifespan for a fiat currency is somewhere in the range of 24 years. And we've got very obvious, very recent examples. We can look to our neighbors, Zimbabwe, and we know very well what happened to their currency. And there's also episodes of hyperinflation happening in Venezuela, Lebanon, Turkey at the moment. So these events are a lot more common than we would think. Now compare that to cryptocurrencies. Yes, they're very new. We only have a 10-year history. But if they succeed and their decentralization continues to grow, it's very likely that these networks can continue for hundreds, if not thousands of years. And then lastly, decentralization. Again, Jonty went into that and explained how blockchain operates in a decentralized manner as opposed to a central bank. That's kind of a sick characteristic that we can now add into the mix when we are evaluating different currencies. Okay, so looking at Bitcoin and evaluating its performance over the last year, up 181% over the last 12 months, which obviously has been very good. And yes, that comes with a lot of volatility, but the last 12 months for the crypto market have been very, very positive, pretty much across the board. Now, in terms of liquidity, which is also a very important metric, because people need to be able to transact in these currencies without delays or without any added friction. And from a liquidity point of view, we are seeing the market grow quite drastically month on month. For Bitcoin in particular, it trades on average around $5 billion per day at the moment. I discussed its scarcity, and it's strictly limited to 21 million coins. And the reason we can say that is because its supply schedule is regulated by the protocol and by each peer on the network that verifies that protocol. So unless there is a 99% super majority of nodes that decides to change that limit, it's practically impossible to ever add more coins into circulation. Okay, another little tidbit about Bitcoin, and one of the pitfalls that often gets overlooked. When you are handling cryptocurrencies and transacting with them, it's very easy to make a mistake. These networks it's a new technology. There are certain nuances and certain areas where people need to level up their understanding before they can safely use them. And what we've seen in the short history of Bitcoin is that a lot of the loss in the space comes purely from user error and not being able to store their currency safely. So that's something that needs to be kept in mind. Okay, and then lastly, the overwhelming value in the space, in my opinion, comes from people who have a long-term view and see the long-term potential of this market. Infamously, cryptocurrencies are extremely volatile, and that's well understood. But the overwhelming trend is that adoption is increasing, and with increasing adoption comes increased value in these networks. And so there's a great chart that shows that the price of Bitcoin has never dropped below its 200-week moving average. So anyone that's actually held Bitcoin for a period of 3.5 years or more has never suffered a loss, even with all the volatility in between. Okay, so a great visualization of where the market started and where it is today. This is a 5-year chart of 3 of the largest cryptocurrencies at the moment. So we've got Bitcoin, Ethereum, and Cardano, and then the black line shows their combined market cap. So looking 5 years ago in 2016, you can see that these networks practically had a combined value of 0. The technology wasn't very well understood. It wasn't very widely used, and it had very, very little utility to individuals or anywhere in the market. So from something that was valued at 0, in a very, very short space of time, 5 years, we now see this market having a combined value of over $1 trillion. For these 3 assets, for the entire crypto market cap, we actually saw it go over $3 trillion in valuation earlier in the year, currently sitting at around $2.5 trillion in total market cap. And again, I like this snapshot because if we compare it to something like gold, which is a 5,000-year-old asset that everyone understood, and it's quite easy to invest in gold itself, that has a market cap of just under $12 trillion. So cryptocurrencies are about a quarter of that value. And if these adoption trends continue, I believe it's just a matter of time before crypto overtakes the size of the gold markets. Okay, right now, another comparative snapshot of how Bitcoin has performed against other markets. So in this visual, I've compared Bitcoin on a 5-year time horizon against major equities markets. So we've got the S&P 500 in red, we've got the JSE, and then I've pulled out Amazon and Tesla as 2 of the best performing stocks probably of the last decade. And not shown on the graph, but I have comparative numbers here as well of South African 10-year bonds and real estate indexes. And I think the key relevance of this graph is that over a 5-year time frame, nothing comes close to the returns that Bitcoin has offered. So Bitcoin returning over 7,000% in that time frame. The next closest being Tesla. Tesla 1,660%, and Amazon 316%. And then as soon as you move away from those 3, it's not really in the same ballpark at all. Gold very flat over the last 5 years, only 30%. SA 10-year bonds 4%. All the real estate index data that I could find shows negative returns over the last 5 years. So in terms of thinking of an allocation and how to put together a portfolio, I think cryptocurrencies are at the stage where, it has to be considered to form some, to take up some percentage of a long-term investor's portfolio. Okay, so that's just a quick overview of the different types of currencies in the crypto market. I'm going to hand back over to Jonty, and he'll take you through some of the utility tokens.
Donny, thanks so much. Okay, so and Donny touched on cryptocurrencies as an investment. The second focus point today is utility tokens. Okay, so when you transact on the blockchain, there's a transaction fee, a cost that needs to be paid. But that cost isn't paid in rands or dollars or any fiat currency. It's paid in the utility token of that blockchain. So if Postnet in the example earlier was transacting or using the Ethereum blockchain, then any user of the blockchain would pay the fees, the related fees in Ether, because Ether is Ethereum's utility token. Let me give you an example which you can relate to. So if you buy shares on the stock exchange in South Africa, as I mentioned earlier, Straight is the central body that will confirm and register your purchase or sale of shares on the JSE. Straight charges a fee for performing that service, and that fee is paid in rands. But in the cryptocurrency world, on the blockchain, that fee is paid in the cryptocurrency or utility token of that blockchain. So if you transact on the Ethereum network, you'll pay the fees in Ether. If you transact on Cardano, you'll pay it in ADA. If you transact on Polkadot, you'll pay for the transaction in DOT. Now, this is very important because as an investor, you need to, if you believe as I do that blockchain or blockchain technology is really the future for many businesses, you need to ask yourself the question, which blockchain technology is going to be widely adopted? Now, if you have a look at the image in the middle, here we have the Ethereum network, and we have all these different businesses, or the correct term is protocols, which use the Ethereum network. So why is this relevant? Because the value of the Ethereum utility token is increased, or it increases in value for 2 reasons. One is adoption. So every single time you transact on the Ethereum blockchain, you need to pay in Ether. Now, basic demand and supply principles will tell you that the more people need to buy a certain object or item, price will go up because supply is limited. So that's very relevant in the blockchain environment. The more and more people transacting on the Ethereum network, more and more Ether needs to be purchased. Therefore, the price of Ether keeps going up and up and up. then when businesses or protocols start using the Ethereum network, their users who transact with them also need to directly or indirectly buy Ethereum. So more and more, the usage of the Ethereum network will result in more and more Ether being purchased and the price increasing significantly. That's the one way. The second way is people like myself and potentially you. I see an opportunity to purchase the Ether as an investment case, because I'm seeing a huge adoption in this network, and I believe that the price will continue to go up and up and up. Now, if we have a quick look, the Ethereum network is valued at just under $500 billion. So that's its market cap. It's experiencing currently on average 1.2 million trades per day. So the volumes that are going through the Ethereum network is really, really high. And as an investment case over the last 12 months, the Ethereum network, as of November, went up just under 700%, which is really, really incredible. Regardless of volatility, I think the Ethereum network, personally, I don't think it could ever go to zero, given the amount of transactions that's taking place and protocols that are being developed on the Ethereum network. Other competitors is Cardano, which is around $44 billion in market cap, and Polkadot, which is around $27 billion in market cap. If you compare Ethereum to major banks globally, their market cap far exceeds many, which is a good sign for investors, given its wide adoption and interest from investors to invest. Okay, so we've dealt with cryptocurrencies as an investment case, the likes of Bitcoin that are looking to replace fiat currencies. We've then dealt with layer one, which is blockchain technology, Ethereum, Cardano, Polkadot. And now we're going to move over to the protocols or businesses which use the Ethereum network. So earlier I gave you the example of Postnet. Postnet could be on a blockchain, but there are many, many, many businesses that are seeing huge volumes in trading, which are using various blockchain technologies. The first example I'm going to give you is Aave. So Aave is completely decentralized. If you are a cryptocurrency investor and you need some cash, maybe you need to renovate your house, and you really don't want to sell your cryptocurrency, well, what you could do is deposit it with Aave. Aave will hold your cryptocurrency as collateral, and depending on the cryptocurrency, give you roughly between 40 and 60% of the value of the cryptocurrency as cash, so that you can go and renovate your house. You then have an obligation to pay interest. If the cryptocurrency drops in value significantly, Aave will simply liquidate your position and recover the capital that it needs to service the debt. Or if you are sitting on cryptocurrency, you can deposit with Aave, and Aave will pay you interest. And that interest varies from 1% all the way to 15, 20%, depending on the cryptocurrency. The interest rates fluctuate significantly. So if you are in the market, you'd have to watch it. You'd have to watch the interest rate that you're receiving. But tokens like Aave have done unbelievably well. Currently, there's just under $250 billion deposited with Aave, and total borrowings is around $51 billion. But where the investment case is when you paying Aave interest, or when you're receiving interest from Aave, you're receiving it in a utility token, in Aave's utility token. So the more and more interest being paid or being received means that more and more people need to buy Aave in order to settle their obligation, as an example. This will then, again, normal demand and supply principles will result in the price of Aave going up. Or investors like myself will invest in Aave, because we can see that more and more people are depositing cryptocurrency with Aave to either receive a return or to raise some funding. Another example, this is an example of the interest rates as of last week. If you deposited USDT coins with Aave, you'd receive around 8.2% in dollar terms, which is really, really high. If you needed to borrow and you borrowed USDT coins, you pay around 10% per year. Again, it all depends on the type of cryptocurrency. Another example of layer 2 is Uniswap. So currently, if you are looking to transact with Aave, you can transact with any blockchain, and you sitting on Bitcoin as an example, Aave is an incredible protocol which allows you to deposit your coins, your tokens, and then exchange it for Ether, for a USDT coin, for Aave's coin, and it's an exchange. Its market cap is around $10 billion. Both Aave and Uniswap see enormous amount of flows, and they have a total of 0 employees working for them. Once the protocol is set up, it's all automated, decentralized. Where there are people working for these protocols is in development, potentially looking to launch version 2 or 3, but the actual protocol needs no human interference. So as a business, we see opportunities we see 3 opportunities in the market: cryptocurrencies as a form of investment, utility tokens, which are related to a blockchain, and certain protocols which offer people within the crypto ecosystem to potentially lend money, borrow money, or to exchange, as 2 basic examples. There are other opportunities in the market. There's yield farming, and yield farming, as I mentioned earlier, you can buy a cryptocurrency, you can deposit it with Aave or other protocols and earn interest. It is something you need to be really actively involved in. This is something that we're looking to launch as a business probably in Q2 next year, where effectively we can continuously monitor the market and see which coins are generating the highest interest rate, and then give investors really nice dollar returns. Another opportunity is the metaverse. So the metaverse is a virtual world. A good example is a PlayStation game where you can walk around, let's say Sandton City, and walk into a shop. If you need to buy or renew your MTN contract, you'll walk into MTN. There'll be a person on the other side of the counter. You'll engage with that person. You'll ask them questions. You'll walk around the store. You can sign the contracts and then wait for delivery. You would need a persona. This is me. This is my virtual personality or person. And there are a number of metaverses or virtual spaces that are being created. Facebook noticeably recently changed its name to Meta. It's investing $10 billion into this virtual world. And I think one of the real benefits is that you can work anywhere in the world in the future. All you need is a good Wi-Fi connection and a laptop, and you could be based on the coast or in a foreign country. But as long as you are able to connect to the internet and engage with your peers on the virtual world, you'll be as productive as being in the office. Another opportunity which is getting a lot of media attention is NFTs. An NFT is a non-fungible token. It's really a token which is in some cases takes a real world object and tokenizes it, or it's where someone has developed art, digital art, they tokenized it, and that's been put onto a blockchain, which will then give the owner the absolute right to that image. I don't see huge value in digital art, but billions and billions of dollars is being spent on this art. As you can see, OpenSea, which is one of the biggest markets in the world, they've seen trading volumes as at November of $10 billion. So there is huge demand. I don't really understand the investment case. What I do understand is I think there's a big opportunity in NFTs, but outside of art. For example, in the medical industry, all your medical records could be digitized and put onto a blockchain, and that will allow any doctor anywhere in the world to access it, have a look at your information. If you do need the doctor, or if you're in an accident and they need your information, they'll go onto the blockchain, they'll pull your personal information. Other opportunities is really digitization of anything that needs to be registered. So your car, all cars could be removed from the government system, put onto a blockchain where you can simply confirm who owns it, all the details of the car. And if I want to sell it, well, I can just sell the token to a willing buyer. Similarly with property, it can be tokenized and very simple, efficient, and cost-effective to transact over the blockchain. Moving to trends and risks, I'll now pass you on to Andoni.
Excellent, thanks, John T. Okay, so hopefully what you will have gathered from the presentation so far is that there is a ton of innovation happening in the space, and it's going through rapid growth and adoption. But coupled with that, and coupled with any new technology, there are always risks inherent in getting involved in a new space and learning how to use it safely. So let me just run through what some of those risks have been historically and kind of how they're being mitigated going forward. So number one, complexity of handling cryptocurrency and transacting cryptocurrency and storing cryptocurrency. I mentioned earlier already that over 20% of all Bitcoin in circulation has been lost simply from user error, making a mistake, forgetting a password, sending a transaction to an incorrect address. And one of the pitfalls of working in a decentralized network is that there's no customer care line to quickly phone and say, oh, please reverse my transaction because I did X, Y, and Z and was supposed to go to Bob, not Pete. So there's no safety net in a decentralized network like we used to with centralized networks. So people need to be aware of that. The market is also 24 hours, 7 days a week, and traded in every jurisdiction on earth. So there is no downtime. If you take a position in the market and you think you can go to sleep on Friday and look at it again on Monday, you might have a problem on your hands because these prices trade all over the world 24 hours a day. There is no downtime. And then lastly, the market risk. There's market risk inherent in any asset. Gold can be devalued. National currencies can be devalued. Companies can go through bad quarters and have their share price drop. So market risk is inherent with any investment and any asset class. And cryptocurrencies are no different. Yes, I think there is slightly added risk because it is such a new technology and people are still upskilling and educating themselves. And I think that reflects itself in the volatility in the market. So that is definitely something that also needs to be kept in mind. But onto the good stuff and the trends that we are seeing. And I think if we sort of zoom out a little bit more and we look at the last 30 years, the overwhelming trend has been migration towards digital networks and digital products. And we see that in the traditional markets. The biggest companies in the world are the FANG companies, your Facebooks, Apple, Amazon, Netflix. They took some product that existed in the physical world and they digitized it. And people have slowly but surely been moving away from physical services into digital services. And I guess you can look at that, and anyone who saw that trend happening in the early 90s, late 90s with the internet becoming easier to use, or any investor who recognized that would have made a lot of money investing in the space. But now in the last 10 years, where I think the next major trend is, it's still digital, but it's moving away from those centralized services and into the decentralized, towards decentralized platforms. And we have the data of the last 10 years, and I think that trend is well and truly going to continue as we progress. And we see this happening with growing adoption, not just from retail market. We see listed companies in the US starting to invest in cryptocurrencies, using it as a reserve asset on their balance sheet. We see it being recognized as legal tender in El Salvador. Whether or not more countries follow that lead remains to be seen, but it has set a precedent. So growing regulatory acceptance, getting easier to use, better solutions for retail to access cryptocurrencies. And I think overwhelmingly, we're going to see that adoption trend continuing to grow in the future. Okay, so who should be investing? Again, I liken this market to the tech boom of the early 90s. And I think anyone who saw tech, the trend towards tech, and invested in it and took a sort of a smart approach to diversifying their exposure did very well. And they did definitely way better than the person who was afraid of the trend and afraid of the new technology and stayed out of the market completely. So who do we think should be investing? Any investor with some amount of risk appetite and someone who sees and believes that this trend will continue. Again, it's still a risk asset. And we've mentioned the volatility time and time again. So investors need to have proper risk mitigation techniques when it comes to how they're allocating. So generally, a small allocation is the best way to enter into a new and growing market. So in general, we see people allocating 1 to 5%. And I think most importantly, this market has best served long-term investors or investors with a long-term view. In my personal experience and people who I've met who are trying to come into this market and trade daily, try and find dips and sell on peaks, and getting in and out and taking leverage and taking higher risk positions, overwhelmingly, I find those people end up losing. Whereas people who come in with a long-term strategy, 3 years, 5 years, 10 years, perhaps even longer as the space grows and the technology matures, those investors with a longer term view overwhelmingly are coming out way ahead of anyone else. Okay, and then lastly, why? Why do you add this into your portfolio? And I think the best explanation for this is that it has an asymmetric return profile. And what do we mean by an asymmetric return profile? So this is just a basic numerical example. Okay, so we've got 3 portfolios compared to one another. The dark blue line in the middle is just a basic portfolio that grows at 10% per annum with no exposure to risk assets. So 100 Rand invested in that portfolio is going to be worth 146 Rand at the end of 4 years. Okay. Now, if you take that exact same portfolio and you allocate 2% of the assets into cryptocurrencies or any other high risk asset, and that allocation goes to zero. The market goes sour, or the technology fails, or anything negative happens, and those assets become worth zero. Now, that portfolio at the end of 4 years is worth 143 Rand. So it only underperforms the safe portfolio by 2%. Now, on the flip side of that, if we see the trend continue and we see adoption continue to grow, which gets reflected in the price of cryptocurrencies, and historically we've seen them grow 200% year on year. So if that same portfolio with a 2% allocation grows at that rate, then as opposed to 146 Rand at the end of 4 years, you've got 185 Rand, which is a 27% overperformance. So the potential for asymmetric returns is probably the best reason to consider allocating towards cryptocurrencies. Okay, now just a little bit of a light-hearted example and what kind of asymmetric returns are possible in this space. This is a Shiba Inu is a meme token, so to speak. It's kind of like Doge. And because these networks are public, you can track wallet addresses. So this wallet address bought approximately $8,000 of SHIB. What would it be now? Almost 18 months ago, 17, 18 months ago. And a bit earlier in the year when that token had a massive run up in its price, that $8,000 was valued at $5.7 billion, which is just an astronomical return. But again, other elements of the market need to be taken into account because that 5.7 billion is not really a realizable amount because of the liquidity in the market. Shiba Inu is not a widely traded coin. It's not accessible on a lot of exchanges. So the truth is they probably wouldn't be able to realize that value, but it's just a snapshot and an example of what is possible in this market. Okay, last section of the presentation, and possibly the most important, what are the current regulations and what are the tax implications of investing in cryptocurrencies? Okay, so first to the punch was SARB quite early on in 2014 when probably most of us weren't even aware of cryptocurrencies. SARB came out and released their position on Bitcoin and cryptocurrencies. Very simple opinion that cryptocurrencies are not legal tender and probably never will be, and that they cannot be used to avoid exchange controls. And that applies to any asset or any monetary instrument. Individuals cannot breach exchange controls, and Bitcoin and cryptocurrencies are no different. Beyond that, it falls outside of their scope, so they are unlikely to issue any more guidance as the Reserve Bank. Okay, then secondly, slightly later on, April 2018 was the first advice that came out from SARS. And again, pretty simple. And it dispels the notion that many people assume that cryptocurrencies are not regulated. This guidance gives us enough of a framework to understand how to treat these assets. So what did SARS say in 2018? Essentially, they labeled cryptocurrencies as an asset of intangible nature. So it's treated exactly the same as any other type of intangible asset. And taxation depends on how the investor used that asset and treated that asset. I'll go into a little bit more detail on the next slide. But before we move there, probably the most important regulatory body of the slide is the IFWG, and perhaps one that most of you have not heard of. That is the Intergovernmental FinTech Working Group. So they are tasked with regulating fintech, and cryptocurrencies fall under that classification. They consist of members from all the major regulatory bodies: National Treasury, Reserve Bank, Financial Intelligence Center, and FSCA. They have released 2 papers, the most recent being in June of this year. And it's a very detailed policy recommendation. And it speaks towards how cryptocurrencies will eventually be explicitly regulated. Overwhelmingly, it's positive. They recognize the innovation. They recognize the demand that the market has for these assets. And they are seeking to bring it under the regulatory purview and officially put those rules into law. So what we think will happen is there will be a classification for vendors known as a CASP, Crypto Asset Service Providers, and there will be a specific licensing category for those providers as well. But until then, we use the framework that we have from SARS to handle these assets. Okay, so just zeroing in a little bit more on tax and what those factors are that determine how cryptocurrencies get taxed. It's a gray area, so it's not black and white. And the major factors to consider is the investor's intention, their time held, of the instrument or the cryptocurrency. In general, the threshold is set at around about 3 years. But again, that's not black and white. It depends. All factors are considered as a whole. It depends also on their knowledge and their understanding of the market. And lastly, their circumstances for liquidating that investment. And those are the factors that will determine whether gains are taxed as income or as capital in nature. Okay, and that brings us to the end of our presentation. Jonty will take you guys through what we're currently offering at Jalotech, quite a novel instrument, and I think you guys will find it quite interesting. Over to you, Johns.
And Donny, thanks. Just a couple, just less than a minute explanation. So at Jalotech, we've developed a basket of cryptocurrencies. So what this allows is investors to invest into our basket and currently get exposure to 7 cryptocurrencies. And the formation of the basket was formed through a criteria that we developed. A couple of the criteria include a minimum market cap of $2.5 billion. Then there's requirements around security, around liquidity, around cryptocurrencies being globally available to ensure that our investors can exit within 3 days at the moment. But what I believe we've achieved here is a basket that will track the market. As soon as the next Apple, Microsoft, Amazon, or Tesla of the cryptocurrency world emerges, we believe that it'll either currently be in our basket or as it grows, it'll fall within our basket. So we're not looking to offer investors 2,000, 3,000, 4,000% returns because we're not investing into small cap cryptocurrencies, hoping or praying that they're gonna grow. We're investing into the large cap players because they've already reached huge scalability and adoption, and we're looking then to ride the wave of their success. And a good example is Ether. In the last year, Ethereum utility token achieved over 600% growth. So this Ether, amongst others, forms part of our basket. Our minimum investment is only 10,000 Rand. And if you want any more information, you can go onto our website and have a look and schedule a meeting if you are interested. But that concludes the presentation. I think what we will do is, if Mike, if you wouldn't mind just going through a couple of the questions. Thanks.
Thanks for that, John T. Sachs and Andoni Nicola. What outstanding presentations. The content shared was illuminating. Knowledge transfer was there, lots of clarity. And I trust that you've all found this very, very valuable and very educational. One or two people have hopped off. Please stay with us for the next 10 minutes. We've got a lot of questions, and I'm going to ask John T. and Andoni to answer those in a quick fire manner so that we get through all of them. And I see the questions are coming through on chat and Q&A. I'm going to refer to the chat first and just scroll through here. How is the Jalotech crypto basket different from the Easy Equities solution?
Simply put, so the Easy Equity EC10, there's a completely market weighted. So as a result, Bitcoin and Ethereum make up 80% of their basket, and other coins only 20%. So in my personal view, it's not broadly diversified. You're really focusing at two cryptocurrencies, where ours is 60%, well, 30% Ethereum, 30% Bitcoin, and then the rest is the rest of the cryptocurrencies. So we've capped Bitcoin and Ethereum. So I believe we're significantly more diversified than theirs.
And the difference to Luno, John T. and Andoni, how do we actually invest with Jalotech?
Yeah, so if you are a seasoned investor and you open a Luno or Valo account and you want to buy your own cryptocurrencies, by all means, do your market research, try to take, try to take out a lot of risk in terms of your investment case. But if investing doesn't interest you, if the research doesn't interest you, ours is a really simple, easy way to gain access to the market. You go onto our website, complete a form, and you be within a couple of hours, you'll have exposure to the cryptocurrency market.
Great question from Craig Methrel. Andoni, I want you to handle this one. There are a number of examples of companies adopting blockchain technology of their own across the world, example, to settle currency trades, but no utility tokens are issued to the public or shareholders. How do we know which blockchain networks have use cases in real world companies as we know them?
Sure. So I think the best way to see which blockchains are gaining adoption and actually being used is to look at the on-chain data, as we call it, directly. So because these are open networks, you can log on to a block explorer, or if you're running a personal node, you can log into the data on your node directly, and you can actually read transactional data, and you can draw inferences as to whether the transacting is organic, or or if it just represents big players or whales, as we call them in the market. But that is the best way to actually assess whether there is real world usage going on. And I think overwhelmingly the answer is yes, that it is being widely used. And for me, the best metric is to look at the number of small transactions, as opposed to the billion-dollar transactions that are being moved around, and the number of wallets that are being created on these blockchains. And pretty much across the whole market, that line is just going straight up, and we are seeing adoption rapidly increasing.
Right, John T., talking about bottlenecks and volumes, what can you say regarding Jalotech if we have a bottleneck regarding exits? How will we control that?
Well, this is a very liquid market. The cryptocurrencies that we've gone with, one of the requirements is they need to have huge volumes traded per day, in I think 50 million plus. And what that ensures is that there's liquidity in this market. So if investors wanted to exit, they'd give us a redemption notice, and within 3 business days, we'd exit our investors. This is a very, very liquid market. We're not investing into cryptocurrencies which aren't traded globally. So we're very confident we could exit investors. I think to give people peace of mind, myself and my 2 partners, we are collectively the biggest investor in our basket. We've invested not only in this investment, in all the investments that we offer. So we incentivize to make sure that if we wanted to exit, we could exit easily, and the same with our investors.
Right. John T., I'm going to ask you just to give a short answer to this, to Ian Bessarabi's question. And I think that, Ian, you're probably going to have to DM John T. just to get richer information. Ian says, I found John T.'s analogy of blockchain very well articulated. Is it possible to have a deeper dive on blockchain with specific live projects up and running in South Africa?
Our part two of our webinars will be a lot more technical, but that's interesting. We can look at and see which businesses or protocols in SA are adopting blockchain, and we'll try to give examples. Yeah, happy to do that on our next on our part two.
Yes, thank you. And Donny, quite a few questions about the ESG friendliness of digital assets, in specific reference to Bitcoin using enormous amounts of electricity. Firstly, is it true? How ESG friendly is it, and where are we going with this discussion?
Sure. So firstly, I think the press has given Bitcoin and the other proof of work tokens a very bad rep and kind of misrepresented what is actually going on. But yes, proof of work uses energy to secure its chain. And the more energy it uses, the more secure the chain is, and in theory, the more value that token has. However, the truth is, comparatively, Bitcoin uses probably a 50th the amount of energy that the gold industry uses to mine gold and precious metals. And it uses about 100th of the energy that the banking networks use. So it always has to be put in comparison to what else exists out there. And currently it uses far less energy than those other monetary networks. And the last point I'll make is that it's actually incentivizing miners to seek out the cheapest energy. And in a lot of cases, the cheapest energy is green and renewable energy. And I think the latest estimate shows that approximately 70% of the hash rate on the Bitcoin network is provided by green or renewable energy. So I actually think it's pushing, it's pushing a bit of a revolution in the energy market, as opposed to being a negative.
And again, and Donny, a couple of questions around other players in the market, some of them competitors, some of them doing similar things to what Jalotech is doing. How are you different to GS partners, and how do we compare with Vala? And maybe the question should be, how do we collaborate with Vala?
Sure. So GS partners, I'm not aware of them, so I can't actually speak towards how we differ from them. But if we look at Luna and Vala, they're exchanges. So they run an order book. Any buyer, any seller can go onto that exchange and sit in one side of the order book. We are a service provider in between that, essentially. So we can offer brokerage services, and we put together products like our debenture notes, which is more convenient and regulated wrap product, which takes away out all the complexity. For people using Luna and using Vala, they need to know how to use an order book, and they need to understand the risks that they are taking when it comes to actually handling the cryptocurrency, and especially with regards to storage. Because leaving it on the exchange is also not the safest thing to do, versus having your own custody set up is also a bit risky if you don't really have the expertise to do it. So all those peripheral risks need to be taken into account.
Consolidating a few questions about storage. How is the crypto secured? Is it held in cold wallet? Maybe just talk a little bit about cold storage and why that is one of the differentiators that Jalotech is offering.
Sure. So cold storage is very important because it moves your assets offline, which protects them from any remote hacking, which historically has been very prevalent, especially against exchanges. And with Jalotech, so we've implemented a digital vault setup. We've partnered with probably the largest custody tech provider in the world. They've handled over $1 trillion of value over the last 12 months or so. And what that platform allows us to do is it allows us to set policies that limits access to that crypto, and it limits the frequency and the size of any transaction, and we can set the number of signatories that we want per transaction as well. So it's a very, very robust, very, very safe system, and 100% auditable.
Adam Balkan from Cape Town, I'm not ignoring your question. Adam asks, since Bitcoin may be divided / fractionalized theoretically infinitely, why is it supply limited? I.e., since each coin of the 21 million may be divided in any fraction, to me it would seem conceptually that actually supply is unlimited. Perhaps I'm not understanding.
Okay, so think of it like this. So if you have a pizza, if I cut it into 8 slices or 16 slices, do I have more of that same pizza? clearly the answer is no. I'm simply able to divide it between more people, but it's the same quantity of pizza. And I think that's probably the best way just to think of it with Bitcoin. And the reason divisibility is important is because your money needs to be able to buy the cheapest good in the market. So if you want to buy a chappy for 2 cents, but you can't cut your 100 Rand notes down into 2 cents, then your chappy is going to cost you 100 Rand. So that's why divisibility is very important.
That pizza made me think of lunch, which is a couple of minutes away. Another great question from Adam. Is Jalotech not concerned with respect to the debenture structure that you're obeying the letter, but not the spirit of the law? Are you not skating close to the edge for yourself and your clients? Jonty, can you field that one?
Yeah, so I saw the question and I'm not really sure what Adam means. So when we formed the investment, we obviously wanted to do it in a company so that our investors could come into a fund and then we could invest their money into crypto. And we had two choices. Either we could, the issuing instrument could be equities under 1.18 for an advisor, or as a debenture under 1.10. Obviously, they have FSCA licenses. And for us, it just made more sense issuing a debenture. It's easier for us just to simply exit the investors when they wanted to exit versus valuing the shares, buying the shares back, paying STT. It was just a more streamlined and easier way for us to approach the market. Obviously, we got opinions from Edward Nathan Sonnenberg's ENS Africa, including a tax opinion. So we're very comfortable with the structure. I don't think at all it's skirting along the lines of any law. It's a structure which I think from an investor's perspective, it just makes a lot of sense. But Adam, if you do have any concerns, I'm happy to discuss it offline and give you the peace of mind that you need.
Okay, Isaac asked a question early on in the program. So Isaac, I'm not ignoring you, and it's all about volatility. So volatility is avoided by many people, but embraced by others. The question is, how can this volatility be mitigated?
Sure. So I think I'll take that one. There are various strategies that people can use, but for me, the most obvious strategy is to use a technique called DCA, or dollar cost averaging. So instead of putting in a lump sum today and hoping you've timed the market well, you rather cut that lump sum up or put regular contributions in. And that way you end up smoothing your volatility, and you end up buying yourself in at an average price as opposed to one price at the start date.
All right, and the final question from Galia asked early on in the program as well. A few months ago, all local banks blocked the ability to transact on global exchanges such as Binance. This means we really only have access to Luno, which does not have access to the majority of coins. Is there a central authority formulating a decision around this? Do we know when this will be unblocked, if ever? And if I could add to that, maybe talk about some of the problems we've solved for at Jalotech in this regard.
Sure. So I would assume that central authority is probably the Reserve Bank, because they want to avoid people sending capital offshore, and all those global exchanges are considered offshore entities. So that is most likely where that decision came from. Will it be unblocked? Unlikely. I think capital controls are probably getting harsher, not really getting easier. So I doubt that will be unblocked. And again, just to go on a little bit of a tangent, that is one of the benefits of open decentralized networks, is that can never happen. But on our existing banking networks, if the central authority makes that decision, then we are beholden to whatever that decision is. From Jalotech's point of view and how we are assisting clients, we can broker for clients locally. So in ZAR, we can buy and sell pretty much any cryptocurrency that's available on the market for them. And we can also assist them by brokering with our offshore entities. So we can assist them in dollars and euros currently. That's where we have services set up as well.
Okay, Gary Walker, I'm going to WhatsApp you directly regarding your questions about fees and minimums. Two of the big sound bites for me today were that in the last 30 years, the overwhelming trend has been the migration to digital. And then Andoni added to that, saying the new trend is this migration from centralized to decentralized. So it's worth taking note of that. Thank you, Jonty Sachs. Thank you, Andoni Nicola, for excellent presentations. I hope all of you really enjoyed today's hour and a bit. And to all of you, have a great holiday. Thank you very much.
Thanks, Mike.